what happened?
There's that race, so there's a lot of traffic.
They've kind of everything all figured down there for those folks.
So it's just pass and then there's...
San Miguel's after this today.
Every other.
Yeah, it's every other. And competition, if you will. You've done that before in Arlington, and it's a very kind of architecture-y sort of, you've got to have folks.
Yeah, I saw it in my email.
We do have, I mean, obviously Mark has got a, architecture background. I mean, it certainly wouldn't hurt us, in the sense of, trying to do that. I don't think all of it, it's more just that's a heavy component compared to some of the others.
Right.
They're much more on the
For the
finance
tools,
side.
you are more focused on architecture. We'll enter that. On that might be.
Yeah, no, it's, I mean, then, somehow, some way, I got an invitation list for it, so that was good.
Hey, have you written up on it?
No, I mean, I sent out to all the students and I asked them, how many, if any of them, were potentially interested in kind of, see what we can do from there.
The deadline on that.
Because the timing on that one is January, so I think if I remember correctly, and so that one, folks who got graduated this semester, I guess theoretically would be eligible for, they probably fix it, all of it, those have started since.
How many are you graduating?
4. So, yeah. This works with the also.
Yeah.
There are a fair number of those things that they can flow around across the country. That way, really like.
Yeah. Yeah, the more that get involved, the more friends you make. You don't win. So,
Oh, absolutely.
one thing that, we compete against the schools. And eventually, it's funny that when the other ones that are outbound, it's kind of, they put most time into it. Great job. But you never know, I mean, who knows what kind of time, being allocated at Harvard or whatever at the school.
No, that's true. So, we'll see. We'll see.
Everything else is good?
Yeah. Some people do show up all the time.
I think that in their defense, there's like a ton of traffic for the park.
I have a certain schedule of classes is at 45.
I forgot more about this. It'll be here at 8.
Roughly, we start at 7.
7. You're morning.
That's pretty much what we're doing. I'm in bed asleep by like 9, so.
I thought your email, like,
Yeah, that was
really early.
That was me waking up in the middle of the night and it's like.
Oh, yeah. Good to see you.
All right, good.
Early riser or?
Well,
Yeah, that's obviously the downside of having this open next year, your bed and then.
So what was the
Yeah.
first one? Did you make a PowerPoint?
Yeah, dude, I did like 3 slides.
Yeah, I did like a picture.
Your eyes.
I typed what the article was, synopsis, and then
I'm just gonna speak. I just put like, it's literally like one, it's like a picture and then the title.
No.
Like 3 or 4 bullet points I'm gonna go over.
Yeah.
And then it says last one says conclusion.
yeah, I did the same thing.
Does he really require that?
I don't know.
We'll find out. I figured
I don't know if
I'd
he
make
said to have one, but I may want to just. He may say no, just to do it off.
Do you email it to yourself?
Yeah.
Alright,
So it's on the internet.
That's kind of old video right now.
So, did we ever come close to this?
Yeah, I figured, I mean, it's gonna take 2 seconds. I was like, I might as well just make one.
Over deliver.
Yeah, I mean, I I sent out a message to you guys,
Yeah.
and then what, right, the next day?
Yeah, everyone's like, all right, maybe we need to do this.
Exactly.
Right.
What time will there be out? For you guys to approve?
How's your week?
Good.
Yeah.
Good, no complaints. Feel a little cool outside, feels nice.
Right? They got this huge walkathon going on though, that caused havoc.
Parking garage?
Yeah, everyone's in late. So they should all be penalized.
Morning. Oh, that's for them, I look at the best, yeah.
Morning, morning. Morning.
You know what network you connect to on this?
He's got, I don't know, before he's put one up yet, but
I sent it in,
usually it's a hotspot up.
I only remember.
Where you log into?
Oh, no, oh, the.
Yeah, like if, you know, like which network is it?
Oh, geez.
There's like a million of them. I feel like it's either FAU or.
Try the BC guest, or BC public, either one of those. And
They
then-
might not need it.
Yeah, and see,
I only need a connection for like a remote.
you know, you can always try to steer the cable here.
Oh, wait, same
Si
thing.
no puedo decir nada, pues, no, lo que es eso
Right,
y
okay,
es el
you should
dedo.
maybe set it here.
There we go.
You still may have to log, I don't know.
I think I'm still logging in for Howard. There's a,
Yeah, it's like RM 32 dash
Do you have any other
423.
handwriting?
Yeah.
And then the password is
I'm gonna
capital
I got it. You got it.
ask you,
Mentira, me acusa, mira, me lo devolví. Te lo devolví.
Well, I couldn't do it
Got one?
myself.
Yeah,
Okay.
thank you.
Fancy one, I'm gonna give you a little blue one. How are you?
How was your trip?
Good.
Yeah?
Good time?
No, yeah, I actually put it all together and then sent in. Yeah, well, I mean, if it's in.
Morning.
Somebody?
Yeah, yeah, I had to go, we wanted it for Arlington, it looks like a year-long process.
You started studying?
They had to take it like dinner or something.
No, I actually have finished the idea tomorrow. And then,
Don't worry, next week is crash week.
yep, like clockwork, man, they come in.
What, I mean, minor went to Dublin. It's never as easy as
Jalen. How's the turnout gonna be?
It's only your second event, we're not, like, we're planning for 25 to 40.
You get rented out?
No. We're just, gonna have tables reserved for us, and then, I mean, people aren't gonna wanna stay at the table the whole time, they're gonna wanna go over the table.
What time, when is it?
7 to 9,
Tonight?
on Tuesday night. But it should be good. I think we're gonna have like a pretty good turnout.
Good.
I'm dragging like all of my friends from Lumberville.
years ago.
It's all of them, like,
Gonna make a speech? A welcome? Naturally, efficient rates.
I don't want. What's your article on?
It was about banks, decrease in interest rates. Banks.
So I guess next semester I'll start scheduling the classes at 7:45.
project over there, industrial center? I mean,
Well, it's some of the details.
preliminary stuff. Some preliminary stuff.
Probably get as much done as that.
Right. No, I know, I'm saying, maybe you can get the listing agent. That's, I mean, I don't know, I mean, people that don't have access to those, maybe somebody that buys this does. So that's one of those, it's
I was lobbying to get you in there. I tried my hardest there. No, I haven't done anything. What, can I use that money for, does that have to be like for educational purposes or what? I don't really have any. I don't know if I do in the coming years, but.
All right, this morning, Glen Mowatt from TMCA, Board of Real Estate, Director of Acquisitions there, is going to talk to you a little bit about his background and also about what his company is involved in, kind of how they sort of approach commercial real estate in terms of on the acquisition side, but more specifically kind of what their strategy is. He's also one of our MSRED alumni as well as one of our board members. So please join me in welcoming Glen Mowatt.
Thanks, guys. I know majority of you were in the class a few weeks ago when we went through the due diligence process. So this time around, I figured we should focus more on actually what the on the private equity side, what my company actually does, and you know, again, a very macro view, a big picture. I'm going to walk through 10, 15 slides or so, but feel free to stop me or if you have any questions or want to talk more about anything in particular. So TMSA, the company I work for, they're made up of 3 partners. They're based in Montreal. We got into the South Florida market in 2007 as a closed-ended private equity fund. Our focus was in fractured condos and value-add office opportunities. Our general investment criteria is we look for deals in South Florida between 5 and 25 million. That 5 to 25 million there is pretty much a sweet spot for us, where we find that there's a lot less players in that arena, so we can be a little more competitive, and we're not the mom and pop size, but we're also not institutional, so it's a nice little niche of a market there for us. As I mentioned, we look for value-add office and fractured condos. When TMSA first got into the market, there was a lot of fractured condos left. So that's what we first started looking into. As that got absorbed, we started realizing that the office market was not being tapped into. Everyone was afraid of office at the time, and maybe up until last quarter, I would say that was still the case. Nobody wanted anything to do with the O word. Office was horrible, vacancies were and still is very high. But that's where the returns are, and that's where if you buy in when nobody else wants it, then that's where you can capitalize on the market. We look for very high returns, which is why we have to go for those distressed assets and the value add component. Those kind of returns that you see there, that 15 to 20% IRR, is not normal on the institutional side. The institutional buyers will typically look for something very stable, stabilized, needs very little work, and very strong markets. This is kind of the complete opposite of that. Although we do look for assets in strong markets, we look for assets that need a lot of work and that we'll pour capital into it and lease up. Yes.
Is that your net return after the waterfall or is pre-waterfall?
Pre-waterfall. That's a good
Pre-waterfall.
question. Yes. So that's on the real estate level. Before we do the
That's
promotes.
at a project level, not waterfall
Exactly.
level.
Exactly. That's a great question though. And later on in the PowerPoint there, I'll get a little more detail on how our the distributions work and how it works on the real estate level and then down to the investors. So yes, we look for well located assets, and we want to buy below replacement cost. And the mentality behind that is if you're buying into a certain submarket, you want to make sure that if somebody's coming in to develop, that it's going to cost them more to build, which therefore is going to cost them more and require them to charge more in rent. And like I said, we buy underperforming assets. Besides the due diligence that we went through a few weeks ago, a little bit more what I do for the fund. I start off by sourcing the deals there. So whether it's from a broker or off market or what it may be, I take the initial look at it and make sure that it fits into what the fund is looking to do. After that, I'll do my market research and analysis to make sure that whatever my assumptions were is being, I'm able to back it up so that when I present it to the committee, I can tell them why I assumed the rents what they were, or why I assumed the leasing up in 18 months, or I have to have an explanation behind everything I do there. After that, I send my analysis to Montreal, and we have an analyst there that would put into the what the investors and the promote and the waterfall, and go through that process on the investment side. Then also the due diligence process that we already discussed, and then when we get the property under management, we work on a yearly asset management plan, which is really just a business plan of where do we see this property in a year, and what do we need to do to get it to where we underwrote it at. Here's a few positions at a real estate private equity fund. You have the capital raising position where that person really goes out and seeks money, whether it's from hedge funds, private individuals, high net worth individuals, whatever it may be. Sometimes it's done in-house. Other private equity funds, they have a third party that does this for them. We do it in-house. We have investor relations. So after the money's raised and invested, we have investors that need to stay up to date, and will call in and ask questions and want reporting, and obviously they want their checks, and they want, so that position there kind of deals with anything that has to do with the investors, and answering any questions from them. And as it goes, usually your investors who have the least amount of money into the fund are the ones who are going to call and have the most questions. So that's not much fun. You got the acquisition side, which we already went through. Legal and accounting, which again, those two can be outsourced. We have legal and accounting in Montreal, and the asset management, which again can be outsourced as well. We have a local partner that does our asset management for us, that we partner with. That typically those asset managers, if you do decide to go third party, they would put a few, maybe 25% into the deal, so that they have some skin in the game, and that they are now have invested interest, and then they too will get to participate in the promote. So a little summary of what a private equity fund is. It's just a pool of capital from private investors. It can be anything from pension funds, hedge funds. There are closed-ended investments. When you go out to raise a fund, you typically have a 12 to 18 month period there to to get the money raised. So I'm going to go into more details on all these, but just to give you an overall, here are some essential requirements for forming a private equity fund. You create a business plan. You find, what niche you want to get into, and when I say niche, I'm referring more to an asset class, or even one step further, whether you want to get into, an opportunistic fund, maybe more on the development side, maybe, you want core deals. So then, once you close the deal there, and then you have to manage, and then you have to come up with your exit strategy and how long you plan to hold the assets for. This slide here kind of takes you through what you would typically talk to a potential investor about. If you're going to invest your money with a fund, these are probably the questions that will come up in conversation. And this would also be in a document, a formal document that would be provided to potential investors. The first there being the target fund size. So you want to think, how much money do I really need to raise to do what I want to do? The next question is, what kind of returns are you going to offer your investors? So a lot of funds have a maximum of how much they can leverage on each deal. In our case, it's about 60%, but typically you won't see more than 65% of cost. So what that means is investors will not allow you to put, if it was available, they won't allow you to put 90% financing on one particular deal. They want to be exposed to that much risk. The next deal there is target fund buying power. So you want to know, are you going to JV with another company? Are you going to co-invest? What's your game plan there? The next is the minimal capital commitment. Every fund's going to have your minimum what you can invest. I mean, the last thing you want to do as a fund is have 500 investors calling you every day, and they all have $500 with you. It's not worth it. So you have to set a minimum commitment amount. The next one there with the how long are you going to hold it for? Is it going to be a 3-year fund, a 5-year fund? When the capital is committed, you typically call for capital when you have a deal under contract. So maybe the fund is $60 million fund, but you don't call for that full $60 million at day one. If you have a $60 million fund and you go out and you find a deal that's $10 million, that's when you go out and raise that $10 million, because you don't want to be paying interest on that $60 million in day one. The term there, the diversification there is referring to the percent that the fund can be invested in a single asset. So if you have a $60 million fund and you tell the investors, I'm going to buy 10 assets with this money that we have allocated to this fund, you have to make it very clear to the investors that that's your plan, and that you're not going to just go out and buy one property, and that's to hedge themselves against the risk. And then the management fees there, and the distributions that we kind of already discussed a little bit there.
Let me ask you a question.
Yes.
Do you see lately that institutional investors, not so much high net worth individuals, are asking you for unlevered IRR?
Actually, maybe
the net IRR.
The other way around, because of the rates what they are right now, the interest rates, a lot of, especially on the institutional side, are locking in very lucrative rates. They're going, they're getting 3.5%, 4%. I mean, it's kind of crazy what kind of rates are out there right now. So they're actually locking in long-term debt, and on a smaller scale on what we do, we also have been taking advantage of the rates. So even though we have a fund committed, we realize that the money's cheaper for us to leverage the deals. That, and we're also able to reach our IRR returns that we're looking for.
But my question is, a pension fund or any institution, endowment, etc.
Sure.
They have a metrics to see if your investment thesis goes within their portfolio.
Right.
And one of the biggest questions today when they ask you, okay, you're gonna reach 18 or 20% IRR is, what is your net IRR before
Leverage.
before leverage?
Right.
To see if you're on the 12, if you can meet the pref, if you're gonna be 2 points above the pref, or 2 basis point.
Right. So, and what's your question?
So have you seen that in your fund?
No, I mean, this fund, this particular one, this is our third one we raised, and this one we raised 3 years ago, 2.5 years. And at that time, there was no banks lending or anything along those lines, very few. And for what we buy, such distressed assets that, financing is tough. And on the investor side, they're okay with us putting, once it's at 65% or less, but they're okay with the leverage. But does that answer or no?
Anything on the back end for the sale? An 80/20?
Yeah, I'll get to that slide, but yeah, on the exits there, we get a, promote and we charge points on each, going in, during management. I'll go through that when we get to that point.
Do you have a catch-up beside the split on the
No, we
80/20?
do not. All right, so and basically here we have, with the fund we have general partners and limited partners. So the general partner would be the creator of the fund, the ones who have the legal power, and they're the one who does the investment. The limited partners are the investors. As I mentioned before, the management company can be in-house or it can be a third party. It depends on your expertise and how well your particular fund knows, the markets and whatnot. Okay, so when we start talking about the investment strategies here, we talk about what kind of property types are we going to invest in, the locations, and the style. So when I say investment style, is it going to be a core stabilized asset? Is it going to be a value add? Is it going to be opportunistic? And all those are going to reflect different returns. So you can't expect the same return for a core asset as you would for opportunistic, and vice versa. With that becomes more risk as well. So, if an investor is looking to invest into your fund, they have a certain amount of risk that they're able to tolerate. Maybe they want higher returns, and if they do, then they're going to have to go more on the value add or opportunistic side versus the core deals. You'll see that the institutional guys are going to be in the core side, whereas the high net worth individuals will probably get more on the opportunistic value add. If you're looking to get into to raise a fund for development, the opportunistic is the only route you can really go. Finding a target. So once you have the money raised and you're starting to think, okay, well, what do I want to do? Where is next big boom? Where should I invest this money? And, some things, and I think you went through this with San Miguel on a few weeks ago after we left, but he had you start looking at different market research reports, CoStar and REE and whatnot, and that gives a good start, a good macro view of supply and demand. And today you have so much information online from every big brokerage firm that you can get all this information on a macro level. Now, as I think he had maybe mentioned to you guys, a lot of those reports have a lot of holes in them. I mean, none of them are really perfect. It's really a matter of you being able to understand and getting yourself comfortable enough with whatever markets that you're interested in there, and getting yourself affiliated with that. So a few things that are done for successful funds. They're very clear on what they're looking to invest in. The last thing you want is to confuse your investors. To have them think that they're gonna be in on a core deal, and the next thing you know, they say, well, we didn't sign up for this. So you want to have a very good relationship with your investors, have their trust, be unique. You got to find those unique opportunities out there that there's a reason why they're putting their money with you than somebody else. There's a lot of competition out there with private equity funds. You know, so you want to make sure, you know, whether it's off market or you're looking at a piece of real estate different than somebody else. And to go back to the market research part, you know, you got to know your markets there. You know, don't try to get into a market that you're not familiar with. You're just setting yourself up for failure there. And then be prepared for all scenarios. I mean, it's tough to really you know, look at a deal and not get excited about it, but at the same time you got to think, okay, what if this happens, what if that happens? Because sure enough, when you go pitch it to an investor or a committee, that's the first thing that they're thinking, because their money's on the line. They have millions and millions on the line there. So, you know, not to be too pessimistic, but at the same time, make sure you do think of all your different scenarios. And then, you know, that, I think, to answer the question with you know, how do funds make money? Typically, there's an acquisition fee that's charged to the fund. This is when you find the deal and you get paid whether it's a finder's fee or what you want to call it, but it's about, depends on the deal size, 1% to 4%. There's a management fee that you charge yearly. That even if you have hired a third party to do your property management and whatnot, there's still a management fee charged to the fund, and that's more you know, on the higher level on the asset management side. Then there's a disposition fee that is paid to the fund, and then below that is when the promotes come into play, and if you hit certain thresholds with your returns, you have a you know, promote that you're getting a bonus. You know, it's a good way to look at the promote. And then, yeah, that's how the profit participation works.
Quick question.
Yes.
On the management fee and the disposition fee, what type of percentages are typically?
Management's typically about 1%, and then disposition is equivalent to your acquisition fee, so 1% to 3%, depending on the deal size. And you'll see that these fees are standard across the board with any fund. They don't really compete on this level as far as trying to cut their fees so that they can, you know, raise more money and whatnot. Everyone across the board is pretty much the same, and that's a pretty brief summary there. If anybody has anything they want to, you know, go in more detail on, I kind of went through it pretty fast there, but yes.
So when the fund starts, what is it, like a Reg B private placement type?
It depends. So it depends how big. And Dr. Ford, you might want, if you want to jump in and get in more detail there, but you do have to go through you know, federal approvals. You want to also, one of the things I probably should have stressed more is you want to have a legal counsel very involved, because there's, you know, each investor has to have certain, you know, make a certain amount of income per year. They have to have a net worth of you know, X dollars. So there's a lot of requirements for these funds. I know there was a recent act that was passed, the Jobs Act, about a year ago. Are you familiar with it? Or?
Very much. Yeah.
Oh, okay. And I just started. You know, we have nothing to do. You know, company-wise, have nothing to do with it. But I was curious on it, and I started researching it more. And you know, it put a lot. It took away a lot of the requirements, which was nice, and which allowed, you know, real estate investors for the first time to go out and use crowdfunding. And there's a lot of those platforms now that you can utilize. And if you want to speak more on it, I'd love to hear.
Yeah, to answer to your question is, depends on where your investors come from, is how you set up your fund structure. If your investors are coming from Europe, you may, even though you have to register because you are the manager, as long as you're in the US, you have to register here as an advisor. In real estate, there's certain exceptions and there's certain rules. And if you pass $150 million, then you have to register, and the registration has two parts, Part A and Part B. Part A is you haven't reached your $150 million, you only have to know the Security Exchange Commission that you exist. Part B is when you go in full registration, you need a compliance officer, you need a bunch of stuff. But either way, you have to do your offering memorandum, your prospectus, you have to fulfill a lot of requirements. But it all depends on where your clients are coming from, is where you're gonna locate your fund. Your fund could be in Luxembourg, could be LP in Quebec, could be Cayman Island, whatever it is, you're still the GP, and the GP is in the US. Most likely it will be in Delaware or somewhere in the US, but you will have to register. And that's normally the process. The fund itself could be structured anywhere in the world where this LP comes from. The only exemption is in real estate in particular. Private equity could be divided into alternative assets, could be divided into buyouts. It depends. Real estate is very particular and has a lot of exemptions. Now, they have softened the rules, and now, about a year ago, they started accepting, in 2008, when the crash happened, they started to accept real estate syndications, and it's called real estate groups or syndicate groups. And that's something that you could form as an outsider, charge, get a promote, get fees, etc. Before that, you were selling securities. They couldn't do real estate syndications. Now you're able to do that. And also crowdfunding. Crowdfunding, it was considered to be also securities. And in my view, it's still a security. No matter how you put it, it's still a security. Because
So does that loosen the restrictions on unaccredited investors, or you still have to have
they're not sophisticated, realistically investors, and you could be tapping into somebody that is putting into your crowdfunding vehicle all their savings from all their lives. It could be, any person.
Yeah.
And at the end of the day, they don't understand the return, they don't understand your underwriting, they will not understand the bottom line, and it will hunt you back at some point. And you have 1,000 investors to deal with. Crowdfunding is very complicated. It's very popular today, but my guess is it will be regulated at some point.
Yeah, I would have to agree. I mean, it's an easier maybe route for somebody who doesn't have the equity sources at hand. Easier in the beginning, but I think in the long run it's going to be more of a headache, and it can get really messy, and there's a lot of variable items that come into play, as you have that many investors. But I guess one way to kind of mitigate going through that route, if you had 3 or 4 investors or friends that wanted to invest in real estate, you can form an LLC, and I think that's a easier, it's an easier way to get away from the whole, okay, you don't have to have X amount in net worth, or so if that's something you're considering, that's a route I would recommend.
So on your fund, like, let's say you want to raise $50 million, but you don't have the property picked out yet,
Right.
and you purchase a property and it's $10 million. So what do you just kind of get like a commitment from?
Yeah, there's
$50 million, and then once you buy it, you call them and you distribute it evenly, type of thing. Like,
right. So there's an alternative to having a fund that's actually raised and the money's committed, and that's doing the one-off deal. So you find a deal, it's 10 million, 50 million, whatever. You pick up the phone and you call those investors that you would have had committed, and you just call them and say, hey, I have this. Are you interested? And those guys, I mean, those investors, they have millions of dollars. They, and if they, you have a good enough relationship with them, that's one route to take. But I know many other funds that do that. The downside of that is when you're dealing with the brokerage community and you're putting deals under contract, they like to see that you have the money committed. They like to see proof of funds. They like to see that you're not going out chasing, okay, I have 30 days to go find money. There's pros and cons to both sides of that. It's nice to have the fund there for a liability, for the purpose of getting the deal. But doing the one-off deals is also not a horrible thing. If you're in the business long enough, you have those people.
Is that what you guys do?
No, we have the fund that's committed. The guys that we partner with for the asset management side, they're a smaller group, and they have 3 or 4 of those guys that if they find a deal, they know the people to call, and they call them up, and they get the money there in 30 days. So,
and then once you reach your maximum amount, what do you do? Just a new fund?
We close out the fund, And at that point, you know, the fund's closed out on the investment side, but we still hold the assets until, you know, whether it's a 3-year hold, 5-year hold, and that's all specified in the investment memorandum. And then it's up to us at that point to say, okay, we're going to go out and raise another X dollars, you know, or if that money's not deployed, and say you raised, you know, $100 million, and the money's, you know, we didn't find enough assets in that 3-5 year period, you can request to extend that fund for another 2 years, 3 years. Another option there is if you didn't deploy all that money and you realize, okay, well, this money was raised in the memorandum there, we said, okay, we're going to buy fractured condo, and it's very obvious for somebody to say, okay, well, that market's not there anymore. At that point, you can go out to your investors and say, hey, I know this fund was originally raised for fractured condo, but we noticed now that the market has shifted, and now we're looking for office deals. Do you want to continue, you know, with us? And you know, most of the time the investors are very open to it. You know, they have their money there to make money. So
for the fraction condo structure business model, were you getting into a high amount of vacancies and you were buying them and then leasing them out?
Yes.
And how did the condo though look at you as saying, hey, I'm coming in as a private equity, we're not owner occupants? Or are they just happy to have someone they're paying maintenance and?
So yeah, so it depends. I guess it depends on the timing of the market.
Right.
When they had such high vacancies in the market, they loved for you know, vultures to come in and you know, buy 50, 60 units at a time. If you try to do that right now on the new construction, no developer is going to have it. They don't even want to breathe it, and they don't want to, because it looks bad. You know.
Right.
We have 32 units right now under contract in West Palm Beach. And out of 307 units, and everyone, you know, the association and everyone there is very pleased to have us there. So you know, it varies. I mean, that building was built in 2007. There was a lot of renters in there. You know, our end game with that as well is that we buy it, we hold it for about 18 months. We bump up the rents. We you know, do a little renovations to the units, and then we sell them individually. So I mean. From an association point of view, it's actually attractive for them because eventually we're going to start selling off one by one, and we'll put money into it and whatnot. So.
How big is the fund?
Our fund right now,
Yeah.
this third one we raised is $60 million, and we have deployed about 50 million of that. So you know, now we're contemplating you know, whether when this one finishes out, or if we're going to do the one-off deals, or if we're going to do, which, you know, the 3 partners there have committed a big chunk of that 60 million. So they're trying to decide whether it's more beneficial for them to do it just one-off, or if that's to have the fund. Yes?
Once, you said like 3 partners, once they commit that capital, are they committing to a specific investment type, or at the end of the day, do they still have the, you know, decision to make a go or no-go decision on an investment?
So both. They invest in a certain investment type based on the memorandum. I should have probably brought you guys that memo. Probably been good just to see what's involved. But that slide, the 3rd or 4th slide there, is pretty much a summary of what's involved in that. But they approve. You know, they go through each line item of what they're looking to invest in. But at the end of the day, after, you know, the deal is found, and whether it's an office building or not, it still has to go through a committee, which is involved with you know, the partners. Some of the investors are on that board, and I pretty much have to go up, or myself and a team. We go up there and we kind of show them the deal, and you know, why it fits into what they're looking for, and why it's a great investment. Yep.
So how many deals do you pitch, and how many of those deals get accepted, I guess?
That's a good question. So a year ago, I would say we had about 10 deals for the year that we really looked at, you know, and spent some time on. I would say out of those 10 deals, we only closed 1. So you know, 10% of, you know, but I would say what came across my desk, probably about 60 deals. So it's a small percentage that actually fit. I mean, the fund has very strict criteria. You know, it has to be in South Florida. It has to be, you know, so once you start narrowing down all the criteria that they have, it's hard to find that niche. And you know, now we go to this year, it's even less than that because it's harder to find those deals with those kind of returns.
And it didn't close because someone else bought it, or just the numbers weren't right, or?
Yeah, so I would only take it to the committee there if it fits all the criteria. You know, we are pretty big on not putting anything under contract or submitting any kind of LOIs unless we know, like, we're 90% sure. So we passed on a lot of them because we couldn't reach our return criteria. But I would say we're not, you know, every fund operates differently. You know, some funds believe, you know, you throw your name in there and you hope for the best, that maybe the first and second bidder, you know, for some reason they don't win it, but maybe you get it, you know, at this price. But, you know, everyone operates a little different. We're a little more conservative, I guess.
Being a distressed fund, is it important for you, your entry cap rate?
No, that's a good question. We really don't look at going in cap rates at all. If we did, we would never buy anything. You know, this deal we have in a contract right now, I think is like a, you know, going in cap of like 2% or something like that. You know, we buy distressed, which means the first year there's a lot that needs to be done. So we look at the future there, and we bought an office building 2 years ago that was 17% occupied. We bought it for, you know, pennies on the dollar, but you know, again, if we looked at the cap rate going in, it just wouldn't ever work. Now, if you're going to go on the institutional side or buy more of a core asset, those investors are very strong on cap rates, and you know, within 2 seconds they can look at a deal and say, okay, what's the cap rate? Okay, no, we're not interested. This one takes a little more homework because it's, you know, you're buying in on the value add side of it. Yeah.
That office, but that was a real one that you bought, a 17% occupied office?
Correct.
So what, like, can you talk about that deal? Like, what made you think that you guys could turn that around?
Sure.
Why was it only 17% occupied?
So we bought it from a bank, and the owner had occupied 70% of the building, and it was a law firm. He had all these other businesses, like he had an accounting company there. He even had a hairdresser, you know, in his office building. He had a gym. He had all this space that he was wasting. It was really poorly managed. He was, you know, doing things under the table. It was just, the building was built in 1986 and just needed a lot of work. None of the permits, the stuff that he did was nothing was filed with the city. So, you know, there was a lot of room there for redevelopment and renovations. We looked at it as, you know, at the price that we were buying it, it was one of those things where you couldn't lose. You know, the time of the market was a big key there. And when we started to put in all the capex that we would have to spend on it, and what rents in that market were and what the rents were, so when we were going to mark to market there, it was ridiculous at how low the rents were for the tenants, the few tenants that were there. So we looked at that as more of a one step further from the value add, and probably more even opportunistic, and for the money that we were going to have to put into that building. I mean, to date we spent about $2.7 million on it, and we renovated all the bathrooms, the lobbies, you know, all the stuff that he did illegally. We did it again, you know, filed it and did it the proper way with the city, and you know, repainted, put new windows where needed to be, and we poured a lot of money into it, and so far it's been, you know, a very successful deal of ours.
What makes it successful?
We've had offers almost twice of what we paid for it, and we plan to hold on to it until we lease it up. So I imagine when we have it completely leased up, it's going to be even more valuable, and you know, the market's only continuing now. You know, just recently in the last quarter, so you see a lot more interest from office investors. Now everybody wants to get into the office market, which is great for us because we got in it when it was a lot lower, and So I think that's going to be a home run for us. Yep.
How did you guys value that for purchase?
I did, my underwriting of how long we thought we can. So we gave ourselves about 18 months to do all the work that I mentioned, the capex that needed to be done. In that time frame, we also worked on finding a good leasing team and doing all that. That's part of the business plan. And then once we got the ball rolling, we started to think of okay, well, what's our exit? What, do we think we can be out of here in 3 years, 5 years? Is it going to take, how long is it going to take to lease it up? So we really underwrote it based on what we thought was a realistic expectation from start to finish. And that requires getting quotes on whatever the capex that needs to be done. Meeting with general contractors, meeting with local market professionals to make sure that okay, we're assuming $23 a square foot in rent. Let's make sure that we can really back that up and that's a realistic number. Or so that's how we came up with that.
So how did you, initially I understand how you got in on the condo side and migrated, so why office space?
The office market at the time when we first got into it had very little interest. We saw a niche there that we thought, okay, first off, office is very capital intensive. It requires not just, right after you buy it, now you have to put money aside for TIs, for tenant improvements, and for leasing commissions, and your ACs go wrong, anything that you can think, expense-wise. So a lot of people stay away from office because of that reason. When you think about retail, for example, you have a tenant that comes in there long-term. You don't really have to give very much in TIs. It's very easy to manage. Or if you look at multifamily or residential, okay, you have turnover pretty much every year. Typically a year, 2 years. But they move out, you change the carpets, you paint the walls, and $1,000 later you're out of there. Office it's a lot more capital intensive, so it's one of those markets where we thought that we can really take advantage of it. We saw the high vacancies. We had very patient capital too, which is another important factor. We knew that we could wait. When we bought this office building that was 17% occupied, it was negative cash flowing. So we were not making any money. We just recently broke even on it, probably about 6 months ago. So a lot of funds and a lot of investors are not looking for investments where they're not making money for 6 months, 8 months, or whatever. Not only are they not making money, they're shelling out a lot of money on top of that. So we thought that was a good niche for us, given the fact that we had the money raised and committed.
Just out of curiosity, you've obviously, I'm sure, come across a pretty wide variety of potential investor types that are out there in terms of competition or perceived competition, that sort of thing. Anything, I guess, that sort of is big opportunities that's kind of really unusual or kind of out there in terms of just the types of things that they're looking for, or the kinds of investment groups that have been put together for different kinds of funds? Or
Yeah, that's a good question. So I think the fund that we have now, it's been the same investors for years and years and years. They've had relationships that the fund originally, they're developers in Canada, so a lot of their investors that invested in their development deals were still happy with the returns, and said, hey, when we told them that we were starting an investment in Florida, they said, oh, well, this is a great opportunity, So I think building the relationships there with the original investors is key, and doing everything the right and honest way pays off in a fund. But as far as those unique investors, I think they're hard to find. I like personally, if I had to go start a fund tomorrow, I would like to do something very creative and more on the, okay, let's take this industrial building and make it residential, or but those kind of funds out there, I can think of like 2 or 3 that have that kind of creativity. And that because that's a lot of that has to do with the risk that comes into play. That a lot of people don't want to take that risk.
You said you have some kind of incentive on your hurdle rates. When do you get that incentive, on the disposition fee or in your carried interest, a higher revenue?
We get it at carry interest. So after the property sells, and we show what our returns are actually realized. At that point, is when we get the carry interest.
Do you have maybe in terms of walking us through kind of sort of the actual financial structure of the deal?
Do I have something?
Do you have any sort of like a case study at all?
Not worth, no. I can email you one, or, yeah. And my role with them, I really handle it more on the real estate side. And as soon as it starts getting to the promotes and the payouts to the investors and what TMSA keep, I send it to an analyst in Montreal, and he kind of puts all those figures in. So I can send you something that he's worked on, but I personally don't really spend much time on that.
So in terms of the actual payout structure, over the life of the asset while you're actually holding it, what, in terms of what percentage is retained typically to operate the property versus how much is dispersed, and whenever it is dispersed, what kind of waterfalls typically, take place?
So we want to make sure we have enough money in our bank accounts to, before we disperse any payouts to the investors, we want to make sure we have enough to cover, any unforeseen circumstances, anything that could, the last thing we want to do is give the money back to the investor, and then say, oh wait, just kidding, we're going to take that back because we actually just had an AC that was on the verge of breaking and it broke, and so we do our best to kind of leave enough money in there, but make sure that we can still get back good returns every month or every 3 months. And I mean, another thing too is that we try not to do it every month. We have, I would say about probably once a quarter is when we pay back to our investors, because it's a real pain to do. I'm not involved with it in any way at all, but it's very time consuming from what I have gathered.
Yeah, I'm assuming that since you're doing distress and you're taking into your underwriting 18 months construction, OPEC, et cetera, you don't return money after 18 months, or probably on 2 years after you start seeing some cash on cash that may start on 1%, 2%.
Exactly. So on that particular deal, there's obviously not any money to the one that we were referring back to, the 17% occupied office building. There wasn't any kind of cash on cash to return. We bought a deal in a few months ago that was cash flowing at day one, and that one we've done every 3 months or so. We write checks to the investors. But yeah, so the distressed deals, we don't, it's very little. And that's another thing that the investors, they know that from day one. So it's not, they know that they're going to get better returns if they wait a little longer, but they know that going in.
I think something important is that there's 2 types of waterfalls. One is the American waterfall, and the other one is the European waterfall. The American waterfall, it's sort of out of date, which is that they used to return money to the investors and to themselves as soon as they sell a property. And they were exposed to clawback at the end of the fund, the GP. So now all the new GPs, all the new funds are adopting the European waterfall, which is that they distribute first 100% to the investors, and then they share the promote. So in that way, the money is protected for the investors. So they have reserves. They pay off first the ref, the investors 100%, and they distribute the catch up and the promote 80-20, which is the norm.
Yeah, that's normal. That's the standard split. And she's right. The very first thing when when capitals realizes that money goes back to the investors, whatever they invested, That's what they get back first, and with their prep. And I would say 95% of funds are set up like that, where the GP doesn't get their promote until the money's returned, their initial investment's returned. And going on the European versus American structures, that's where there's differences on do you get a 1% management fee on the money raised, or you get it on the money that's actually deployed. There's those kind of little differences between the European and American funds. Some European funds don't take an acquisition fee up front. They'll take it in the So are you with a European fund, or you have one? Or?
I manage a fund.
Oh, okay. So maybe you can talk a little about the European funds and how they differ.
It's just the way it is structured. It's the structure. The American funds, before this crisis and the crisis prior, they get into a lot of trouble, and they had to dispose assets at a very low price because they have to disperse the money. They used to get paid once they sell a property. They split the 80-20 at that time. So when the close ended, the fund ended, they were provisions they are called clawback provisions. They go back to see how much money one has received, how much money the other one has received, if they met the pref, if they distribute 100% of the capital. So sometimes there were a big gaps that the partners of the GP are responsible for and are liable for. So a lot of funds just shift their strategy to adopt the European waterfall, which means that the investors get paid first.
Yeah, what was happening in the last cycle was that the GPs were getting their returns, and they were getting their money and profits, and then the LPs and investors were getting screwed because, and that's why the whole clawback provision came into play and became a very popular provision, because that protected the investors to make sure that they got there first, and then.
But it has more to do with the structure of the waterfall than the structure of the fund itself. It's just a distribution.
Yep.
What are your sources of information for data when you're analyzing a property other than, do you have anything else other than LoopNet or whatever? I mean, how do you do that?
What I personally do, and I guess this is just from being years in the business, whatever, but I like to pick up the phone. I guess I'm old-fashioned. I pick up the phone and call the brokers that we deal with, the appraisers that we deal with, the local the professionals. I like to get the straight from their mouth, because you look at some of these CoStar reports or whatnot, and it's it reports a 30% vacancy in the market, but what's not showing there is that there's one building that is 100% vacant, and that's what's causing half of that vacancy. So it's good to look at those reports for a good general knowledge, but the best source there is really straight from local professionals, and you start to look at enough offering memorandums from brokers and whatnot that you can start seeing, because you can look at LoopNet and say, okay, their asking rents are at $25 a square foot. Well, that's asking. You don't know what the real net rent is, and so I like to look at previous other offering memorandums with the in-place rent roll, and that way you can see what the tenants really are paying, and what the TIs really are and everything like that.
I guess in terms of maybe shifting gears a little bit on and maybe turning to the kind of career side of things, having gone through this particular program and kind of subsequently entering into the job market, obviously in the real estate development industry, it's a very fragmented sort of industry with regard to a lot of different employers, and in many cases, many of them being relatively small shops and that sort of thing. And I guess could you talk a little bit about not necessarily you personally, but also just kind of the challenges, I guess, that folks going into this kind of job market, what are some of the things that they need to be thinking about doing? And
right. Sure. So as many of you probably already saw, there's only a handful of like big enough developers out there that are really developing. Although you're seeing some more smaller guys get into the market now, a little scarier. But it's you know, in the downturn, a lot of those developers became investors of existing assets, so they got into this playing field, and you'll see that there's a lot more of these kind of smaller funds there that they're small shops. They run a really tight, you know, operation with, you know, 2, 3, 4 guys maybe, and those are the ones you'll probably run into a lot more often, you know, when you're looking at with jobs and whatnot. And they all have their pros and cons. I mean, in a small shop, it's nice that you get to see a lot of exposure to a lot of different things. You get to, you know, if you're the director of acquisitions, you're really seeing, you know, the asset management side. You're seeing the disposition. You're seeing, you know, you're getting your hands on a lot of different items. So now, on a big shop, it's nice because you focus in on something, and you're a director of acquisitions, and that's all you look at, and so you become, you know, very, very you know, good at that, what you do. From a hiring point of view, you know, they're gonna, big shop, small shop, whatever it is, they're gonna want to know, you know, the basics of real estate. I mean, it doesn't matter how big the fund is. What matters is that you understand how real estate works. You know, you understand that, you know, how income, expenses, capex, returns. You know, what kind of metrics you look at. Is it return on investment? Is it, you know, is it IRRs? Is it, you know, what makes a property worth investing? So my foundation, my start in real estate was in appraisal, and I think that was a great foundation. I know, Dylan, your family's in appraisal, and I think, you know, if you spend a year or 2, 3 on the appraisal side, you probably learn a lot on the macro level. Not to say, you know, you can't do that on any level. You know, you can go work at a bank and get, you know, a great analyst experience, or on the broker side, and, you know, you kind of have to think, I guess, long term, what do you want to, you know, see yourself doing 5, 10 years, and maybe you do the acquisition side, you go, this is boring, or you get on the broker side, you say this is too risky, or, you know, there's, I guess you have to really assess yourself and see, you know, what gets you kind of excited about real estate. And I do remember when I was in the program, the first day, the director of the program told the class that, you know, I know you guys, you know, you're in a master's in real estate development program, but none of you are going to get jobs in development, which, you know, kind of crushed my heart a little bit there. And I said, whoa, you know, I'm sitting here doing this program, I thought I was going to get into development. But, you know, you know, by the time I was finished with the program, I said, you know, I don't think really, you know, development is the only thing I'm into. I think, you know, there's other things that got me, you know, interested in real estate. So, you know, I think you know, you take advantage of this time that you can call yourself a student, even if many of you are still working. Take advantage of it, and you know, go meet. It's funny how some of the biggest names in the industry, they're willing to meet with you as soon as you say, oh, I'm a student. You know, it's like they all their guards come down, and they get, you know, excited to talk to you, and you know, everyone, it becomes really nice. So you know, to take advantage of the time that you have in the program to kind of decide, you know, look in and do your homework and say, well, maybe I like asset management. You know, I like that side of the business. Or you know, right now is a really good time to enter the job market. There's a lot of jobs out there. You know, if again, depending on your skill level or whatnot, but you know, any kind of analyst position would be a great foundation in real estate.
Any other questions?
How many people work in the South Florida office?
You're looking at the South Florida office. So it's just me here in South Florida, and we have about 25 people in the office in Montreal. My boss comes down about once every 6 weeks or so, depending on how, you know, if we have some deals that we're busy on, she'll come down earlier, and she spends about a week down here, and we work closely together. And then I have a analyst in Montreal that I work closely with. As I mentioned before, you know, as soon as a deal looks like it can work on the real estate side, he plugs in all the promotes and the waterfall distributions. So
So are you like pounding the pavement looking for deals, or are the deals being brought to you?
Both. So you know, deals are constantly being emailed out and email blasts from the big brokerage firms. But you know, I think attending the networking events and meeting owners, meeting the smaller brokers. You know, as a matter of fact, the 2 office deals that we did are both you know, what was considered off market, which I know Professor Samuel went through, you know, the definition of that a few weeks ago. But off market really means not being marketed by any of the big brokerage firms, the CBREs, the Cushmans, the JLLs. It's more, you know, some one-off guy who knows the owner and, you know, gives you a call and said, hey, you know, I know the owner and he's interested in selling this office. Are you interested? So there's always a back and forth whether off-market deals are really, you know, what they're all cracked up to be. But ironically, you know, 2 of our 2 office deals are off-market. All our residential fractured condo deals have been brokered from various bigger, you know, brokerage firms. And then, you know, every now and then we go through, you know, some crazy ideas when things slow down a little bit, and you say, oh, let's look into this market and see if we can find anything that we can turn into this, or, you know, we start to get a little more creative. We do have the privilege of having the fun, and then we also have the partners who are open to other things. So they maybe they'll look into buying a bulk of single family homes, or maybe they'll look into a smaller development deal. So if it doesn't meet the fund's criteria, we've looked at things before where it's just for the partners and not for the fund.
So when you do your pitch, you go to Canada?
Correct. Or Skyped in. So I don't personally go. I'll Skype in, and then my boss is the one who goes back and forth.
And I'm assuming they're doing it in other markets as well?
No, we're actually only in South Florida and Montreal. There's only 2 markets that we're in right now. Yeah, yes.
What are some recent transactions that's pending, that you're working on right now?
What are they?
The recent transactions.
Okay, so we closed on a 100,000 square foot office building in Coral Gables earlier this year, and that was the American Airlines building. For anyone who's familiar with Coral Gables, that was, even though it was considered a value add play, it was a little safer than our previous investment that I recently talked about. The American Airlines building was interesting. It had American Airlines lease was expiring, and they had occupied about 30% of the space, and there was a question mark there whether or not they were really going to renew. And you know, they just had a merger, and there was not really any guaranteed thing going in. So it turns out, you know, right now we're in negotiations with them, but they're going to renew about 20% of that space. And then we have 32 units under contract right now in downtown West Palm Beach.
Any other questions? Okay, all right, great. Thank you very much, Glenn.
Thanks.
All right, and Glenn, if you wouldn't mind staying around just for a few minutes, and
Sure.
folks may have some individual questions for you and that sort of thing.
Sure.
And the rest of you, go ahead and break into your groups for the case study competition. I want to talk to you a little bit about that here in a few minutes. So go ahead and break into those groups and talk a little bit about what you're up to with those.
I'll tell you what I'm up to guys. That same thing I was up to last Saturday.
Listen, I set the Dropbox so you can start dropping off your information. Mark may or may not be here today.
Where's Mark?
I'm not sure what he was doing, but he heard us back.
Yeah, Juan sat down next to me. What happened? Changed everything.
Yeah, I looked over like,
Something
what the hell
don't
was
look right.
that?
You don't feel very holy.
And are you still pretty active in hospitality?
Your aura is not the same as pastor. I need that holiness when I sit down.
How dare you? How could you possibly?
Stop your tendering.
Country specific.
Your tendering soul.
We're about 700.
Wait, are we tendering right now?
No.
Get my phone.
We are not tendering, I promise you.
The Latin American.
So
I got one of my girlfriends on here, she was very creeped out.
but we're doing a lot of.
You live locally?
Yeah. We're doing a lot of development.
Mike's teaching a master class.
Tender?
Great opening.
So that's why I decided, you know what,
You didn't get your master's in Tinder?
I just did it one day. The girlfriend of mine is single, so I was trying to help her find a guy.
Yes,
Single speech.
Tinder, you find your Tinderella?
Tinder, wow.
Colombia, Mexico.
Wait,
It's an app on how you can
Oh, really?
it's actually turning into like an actual like,
dating app.
yeah, like
I
I
should've knew
know
about that a
so
couple
many
weeks
people who have girlfriends from like, it's the plenty of fish that you get.
That's where I was picking up mine.
Yeah. That's straight booty.
My POF, we call them POFers or poofers. That's what I call
Poofers,
them.
that's it, yeah, poofers. Exactly what we're talking about.
POF.
Plenty of fish. That's like it's a trashier thing.
That exists?
Yeah, that was before Tinder.
Man, my poofers were.
A trashier Tinder, I love it.
Exactly what it
I
is.
love my poofers.
When you enter the book,
Don't worry, my girlfriend's a poofer.
How many of the couples?
Oh, how'd it go? You guys go, right?
No, we're going this
Oh,
week,
okay,
right?
good.
Oh, okay. 3 p.m.
Perfect.
Hey, since I'm in front of you, don't forget to call the guy about
I'm gonna need the thing. I'm gonna need your ID.
Okay.
They pull out all the projects.
When are you guys going to that? When are you guys going to that? Freshman construction class?
Tuesday.
When are you guys going to go?
Oh, shoot. I need to get Nova.
Oh, that one. Oh, yeah.
What time are you guys going to go?
Oh.
I'm going on Tuesday with Glen at the airport, Malcolm McKinnon.
All right, sir.
Anything else? But do you want to give it to me today, or are you going to use it for anything tomorrow?
Unless I want to go ball out at the UC.
Why do you look like you're wearing an orange jumpsuit?
I was in jail, man.
This is not like a jail
He's like, I was wearing an orange jumpsuit.
Yeah, well, I requested it. I should follow up on it.
Hey, man, can you move over, man? Freaking out my chair.
Static?
Static.
Oh, that's funny.
Feeling too much static.
By the way, a car was stolen in my driveway, like in my actual driveway. My boyfriend's cousin came over to pick up her kid, and she did what all women do, or what most women do.
Thank you.
Thank you, have a good one.
Appreciate it.
Is it possible to copy the presentation?
Yeah, sure. Do you have an email?
Sure.
It was lovely, man. Lovely. San Miguel probably would have blasted you, but.
Well, he would have stopped me a few times.
Thank you, Glen.
Value has not given
We'll go and take
All
you.
right.
Mark was trying to do something creative, I assume. Curtis back.
Oh, did you really?
People, like, you don't know how bad your back, like, how much you use it until you hurt
Oh,
it.
man, I learned so
I've
much.
heard my back before.
Like, all my bones are connected to this one.
Yes.
Well, that's what it is. It's usually like when I hurt an ankle or a knee or something like that, and you limp on it for a long time. That's usually when I get I can't even I can't put socks on. I can't get out of bed. Yeah, that's
I
I
exactly.
have muscle spasms in my back.
I learned when you bend over and pick something up, it's a 10-to-1 ratio. So if that thing was 5,000, because you're bending over at your thing,
Really? That's good.
it multiplies it by 10.
Well, I was told you don't bend at the knees. You just use all back. You straighten your legs and you just lift
Yeah,
up
you
with
gotta
your
come
back, right?
down. You actually come down.
Exactly, ladies bend at the knees and not at the waist.
No, it's all in the waist. It's all in the back. You're supposed to not use any legs at all.
Women are all, they
That's how
all,
you kill yourself.
but that's, yeah, I learned.
Dr. Voorhees, have you successfully found me a roommate?
Oh, by the way, I'm not going home, so I won't be able to.
Well, no.
I need a female.
Probably Muriel's going.
She is not good.
She just told me this
She's
morning.
going with her boyfriend, sorry.
Oh.
Everybody got a boyfriend. So that's 'cause I'm still trying to find a girl.
We'll go. I don't know
Yeah,
who Alyssa's going with, I don't know.
Alyssa's going with her dad.
Okay, and I don't know about our new folks.
I can ask.
And she wanted me to act like I was a homosexual to go with him.
I
And
did
that's
not
just
say
not gonna
that. I
happen.
just said be a little flamboyant.
That's just not gonna happen.
I'm like,
Every time my boyfriend called, I had to be like, "Hey, girl."
Hey, what's up?
So I'm officially rooming with Tyler. You got a better voice.
Yeah, his voice is better than
You
mine.
got a little
I
less
can do
bass.
He said he pointed out his finger too.
You got it.
boyfriend be waiting at the next port when you get off there.
I'd be like, "Hey, boo." I'd be like, "Hey, boo." What up, dog?
You rang? Is it Tom?
How's it going? How's it going with the construction? You guys done?
No, I gotta finish the videos tomorrow, and then I'm gonna study next week.
I'm not done with all the videos. I have, I think, 8.
You know what? Even if you get,
As in number 8 to 9. I think it's 8, 9, 9.
I finished.
so
at
it's 9
about
through elevators, and then 1 and 2 of high rise.
Interiors. Now, I already saw the movie, the thing.
I'm not in this class, so I'm
Why
very
don't-
interested
why
in all
don't
this
Tyler
movie
look
and videos.
confused?
Are you just gonna go over to the course book and read all your notes that you wrote down?
Yeah, I was.
Yeah, after I do the videos, that's pretty much what I
Fine.
do.
That's what he said the email was.
I'm hoping it'll be like
Yeah.
that.
But if you guys do it, so what I've been doing is I've actually been
Screenshotting the,
Yeah.
All his notes.
So if you guys need it, let me know. I'll look you up.
You screenshot each one you went through?
Every like at the end of
You
it.
know I'm anal Annie. You know I got
After
it.
he,
You know I
That'd
got
be nice,
it.
yeah.
and she has
I wish I had
nice
that. I
little-
wish I had that OCD. Like,
You want to study on Wednesday?
Wednesday. I think I have something in the morning, but yeah, I think I'm good this evening. Actually, I think
I'm gonna go to Nova.
we can go to Nova. Wanna do that?
It takes like an hour.
Sure, my son can come.
Kids are in the library all the time.
Okay.
Yeah, actually, I brought him there last time.
My God.
Okay, got a couple of things I want to talk about, and then we can let you go back to your groups, and then after that, after you're done with that, then you can take a quick break before the next class. All right, the first thing, I just want to kind of get an update from you on the project you're currently working on for my class. So why don't we just kind of go around and let each group give me a kind of a brief overview of kind of where you are, what you're kind of doing, and I'm not asking you to spill your secrets of anything, so that you just kind of give me an idea of kind of where you are and some of the things that you're sort of doing. So why don't we start with you guys, Mike?
We all broke up into doing a certain component of it. I think you wrote it down. I'm going to be handling getting some information from a representative at CBRE and CoStar.
Yeah, we
Okay.
don't need to express that
Nikki
part.
well organized.
Yeah, we started splitting up the information and we've started sourcing our
And not this Sunday, next Sunday, we're getting together to put it all. and start.
Also, we have a what was it, box.com file that's where we're kind of
Sharing everything.
sharing the
Okay.
information with each other.
Yeah, so we're pretty organized. We just need to start putting everything on paper.
Okay, all right. What about you guys? Who wants to be the representative?
We also
Miriam?
have a Dropbox, we have everything organized, reports are in there, and we keep memorandums between us on the ideas that we have for the site, and we're basically to the point where we're matching our ideas with that.
Okay, all right.
Encrypted the file.
And you guys, Dustin?
You're delegating to me. We visited the site in the area and done some, feet on the ground research. And right now we're just breaking it up into who's gonna do what, and that box idea is a great idea, thanks guys.
Okay. So any problems any of you guys are running into? Any issues that, of anything? I mean,
We'll talk to you about that separately. Better
okay.
question.
Well, I mean, anything that's broad, I mean, obviously everyone can benefit from. I don't want, I understand, we don't want to, spill
Money's
any
involved
secrets,
now.
but, in terms of, is there anything though that you're running up against that's problematic in some way?
We haven't physically been to the site yet. We have a day scheduled, but I don't know what access
Schedule.
is like for the schedule. I don't know what access is like to the site. Do we actually have physical access?
We can. I mean, I can get in contact with the owner and or with certain, the firm that's acquiring it. And,
Can I give you the date and time that we'd like access?
yeah, we can try
Okay,
to do
great.
that. Yeah.
Thank you.
Because as I mentioned I think in the email that I'd sent, that November the 7th, we've already set aside as kind of like and that could very well be a site visit as well. But the idea behind that was that you would potentially elect one representative from your group to kind of go in with all the questions to basically the acquiring firm and kind of put all those out there and hopefully get the majority of those kind of answered in one fell swoop.
Yes, sir.
Okay?
That's good.
Alex?
But I guess that might touch on what we were trying to do. We just wanted a more clear objective of what, is it the acquirer is looking for?
Yeah, I mean,
Like
basically what it
acquirers.
boils down to is the firm that's acquiring it, they are really trying to, they know this is what they want to do. They've already obviously drawn up the plans, this is what they want to do. However, they haven't acquired the site, they're not going to close on the site until December. So there's still a fair amount of flexibility, even on the design side, even, you know, in terms of, you know, if there are specifics about how the buildings are even configured in terms of a higher percentage to office space or, and so what they're really trying to kind of determine is how can we maximize the value of the site going in, and you know, what are the features that are going to help us to maximize the value of the site relative to what is the competition out there, what are the competing projects offering, what can we offer maybe in place of what they're offering, or you know, what can we do different to potentially, you know, be more of a niche project. I mean, so I think they're open to suggestions at this point. And you know, I think, you know, even one of the things that I had mentioned was you know, ceiling heights. You know, do they go with sort of a standard ceiling height, or do they, you know, want to elevate that, you know, substantially higher, because that's going to obviously attract a different type of tenant. You know, so those sorts of things are going to be, I think, of utmost importance to them. You know, also, you know, should they concentrate at all on the energy efficiency of the property? You know, how significant, you know, is that? And so, in my mind, I think absolutely at minimum, you're going to have some sort of a chart that's going to identify their property relative to all of the other competing projects, and sort of say, here are the features of, you know, each of these, so that you can kind of say, well, which one has what features, what are the rents that each of them are either currently charging or expecting to charge, who are their typical tenants, and, you know, should this property maybe go after a different type of tenant, whatever tenant that may be. You know, like one example might be, should the space be refrigerated space, to try to take advantage of you know, maybe the import of, I don't know, flowers from other countries, you know, into you know, through the port and ultimately into this facility. You know, what is the transportation access to this site relative to all of the others? You know, how close is it to rail lines? How close is it to the highways? How close to the airport? To the actual ports? And, you know, identifying all of that, you know, on a map at minimum. But, you know, those are the kinds of things. I think it's just, so simply put, how do we maximize the value of the site?
Will they disclose their acquisition price of the land? Or is that something?
That's a good question, and I don't know. I really don't know. I mean, they might, but I don't know. You had his hand up, but.
Are we going as far deep as into like construction costs, like getting down?
Yeah,
like,
I mean,
things like that?
yes, I mean, to the extent that there's going to be, like, for example, obviously refrigerated space is going to cost you more to construct than non-refrigerated space. Highly energy efficient space is going to cost you more than obviously not. And so from the standpoint of at least being able to have some sort of a ballpark comparison between those sort of differences, yeah, those different options. And, you know, I would, in my mind, I would tend to say, okay, let's start out with kind of the stripped down base model of, you know, here are the minimum, you know, sort of thresholds of the most basic industrial space that one could imagine, and then, you know, have it in almost a, whether it's an a la carte kind of thing, or, you know, just simply sort of saying, well, if you add on this feature, here would be the cost per square foot to add it on, you add on this feature, here's the, I mean, something, you know, even though that may not be 100% completely realistic, at least it's, yeah, some sort of a ballpark idea. And because part of what you're trying to do, and when I, you know, sort of say a cost benefit analysis, it's like, okay, that incremental dollar amount that you would have to spend on making the space, let's say, refrigerated. What does that translate to in terms of increased rent, okay? And, you know, so if you're having to spend, and I'm just throwing out random dollar amounts, but, you know, you're having to spend an extra $5 a square foot, let's say, to make the space refrigerated, and I have no idea what that cost would be, and you're only getting $5 a square foot more in rent, or you're getting, well, actually, well, discounted cash flow value, $5 a square foot more in rent, where there's really no incremental benefit of having that space refrigerated, it probably doesn't make sense to do it. But if you're getting a discounted value of rent that is substantially higher than that initial cost, then of course, you know, it probably would make sense to potentially consider that, assuming there are tenants out there that actually want refrigerated space. Does that make sense?
Mm-hmm.
Okay. All right, other thoughts, questions about it?
As it relates to the layout that we have here, is this the layout that they definitely want to go with, or are
It is
we
the
allowed
layout
to-
that they have chosen at this moment, is what I have been told. And it is subject to change.
Within the context of our project, can we change it?
Yes. I would be careful about going too far, but I mean, if there's a legitimate reason to change it, then I say, yeah, go for it. Okay? But I mean, they're looking at this as a very real life sort of scenario, and so, you know, if you potentially change it without a really good solid justification, then they're gonna say, well, that's, you know,
It's gonna cost us more money and
that
pointless.
may not be worth the effort for whatever reason. Okay? Okay, other thoughts, questions on that? Okay,
I'm having one difficulty, but I'll get back to it later.
okay, is it, I mean,
No, just the find
So
the
within-
map that I want to use. And what type of map do you suggest that
I don't really have a strong preference. I mean, just a question of, you know, what you're trying to, I guess,
illustrate? Yeah.
yeah. Okay. The next thing, I sent you guys an email this week about a case study competition that we have been invited to participate in with MIT. And it's a national case study competition. We have to pay, and the school would pay this, the $500 entry fee to enter into the case study competition. Last year, if you looked at the links and that sort of thing that I sent you, it looked like about 20, 30 schools, I guess, you know, typically join in on this competition. You can actually have more than one team representing a school. So, but you know, typically I think the teams would be about 4 or 5 members each. So my question to you, and this would take place obviously not until the winter session, so you know, January sort of time frame. So my question is, those of you that are going to be here in January, are any of you potentially interested in being a part of that? Because if you are, then I will move forward in terms of getting a submission for the team set up. If you're not interested, I mean, this is not a requirement, it is an opportunity, okay? So, any of you just right off the bat say, I want to do this?
I have a question.
Yep.
Do you know, for the winter schedule, I guess, is it, because last semester it seemed like there was a lot of busy work, and this semester doesn't seem like there's as much? Because I mean, I would be interested in doing that, but if it was on top of what we had last semester, I think it would be impossible.
No, I mean, in the winter session, it's pretty much me teaching. So, and those folks that have taken my classes pretty much know what to expect. It's, you know, a lot of computations, and so in terms of, I mean, I don't think I would classify any of it as busy work, would you?
Based on my experience with first semester, you should be able to take it on without too much stress. And Dr. Forgy, in terms of his approach, it's a lot more direct, so you won't be doing as much stuff as we were doing in the first semester, so you should be fine.
There was only 3 classes, correct?
Yeah, that,
Winter term?
it's not as much, it's not as bad.
Yeah. Yeah, the three that basically, Hogan's gonna do a little bit, he's gonna kind of coordinate some of the site visits and that sort of thing, but the bulk of the teaching is gonna be me, and it's gonna be the finance course, and then the 2 development classes. And the development class that he's gonna kind of help with, he's gonna help with the setting up the guest speakers, but we're also gonna introduce another software package into that class, specifically Microsoft Project. And so that will obviously help in terms of sort of the scheduling kind of sort of software. It's a great package, and he's going to work on that. But in terms of the finance course and the development course, my anticipation is that we could probably work that MIT case study into the development class as part of the kind of the requirement for that class. But I wanted to get some sort of a feedback as to whether or not really anyone is interested, because if you're not, then we'll scratch it off the list and move on. Miriam?
Do you have to be in the term to participate? Because some of us are going to be done.
You have to be enrolled. Okay, that is a requirement that you would have to be enrolled. Now, in your particular case, since you would not be enrolled until that fall, I don't know, to be honest, how that would fit.
I noticed a girlfriend of mine from the psych school is applying for her degree already for December. She finishes the same day. Do we go ahead and do that now? Myself, Mike, Dylan?
That is a good question. I don't know.
Yeah, you gotta just do it online, it's sharp point.
No, I know that, but I'm wondering if we've been cleared to go ahead and do that now.
I would go ahead and try.
Yeah.
Okay. My other question is, since we're your inaugural class and there's only 3 of us, do we get like fancy frames? They're $165 on the website. This is a valid question.
We'll think about that.
I would be interested in the MIT if it's.
Okay. Anybody else? Okay.
Come on, guys, get involved. It's gonna be great.
There's money, right?
I'm sure there is.
That one, I'm not sure how they do that. My suspicion is that $500 fee that you pay up front, I would think, given they've got 20 or 30 teams participating, that somehow that money would get then redistributed back for the winners, but I don't know.
More than likely, it's a giant trophy.
Can you compare it to the ULI case study, just because you may only want to?
No, I understand. And this is the first that